Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Welcome to the Smart Property Investment Show. My name's Phil Tarrant. I am a property investor. I'm also the editor of Smart Property Investment. Today I'm joined again by Vivian Kelly, who is the editor of our mortgages and real estate products here at Sterling Publishing. And we've asked Victor Kumar to come back on the show again. You might have heard him a month or so ago chatting about his journey from recent Australian immigrant to multiple property investor, and I hope you enjoyed his chat when we ran it. It was been very, very popular. Guys, welcome. Thanks for coming along.
Good to be back, Phil.
Good to be back, Phil.
Victor, mate, we spoke last time about your journey from arriving here in Australia as with your wife, with I think you had about $4,000 in your back pocket and starting life anew and getting started on the property ladder and how that evolved, over the sort of 19 years since you were at that. Mate, I really enjoyed that, and I was impressed by not only your dedication to personal education and how you equipped yourself with knowledge before you actually went out there and did something. And I thought that was a really important point that you made. But you're a radiographer when you first come to Australia.
That's right.
And you've turned your passion in property investment into a profession. So today I just really wanted to have a chat about how you made that transition and why you made that transition. And then me and Viv really wanted to just pick your brain a bit about how you see the market at the moment. I know you talk about that sort of stuff all the time, but I think particularly now with some of the concerns people are having with the current market, what APRA's up to in serviceability requirements and all this sort of stuff, you might better shed some light on what's going on there. So, mate, just to kick off, how did you turn property investment into a profession? So you're a director of the Right Property Group now.
That's right.
You're a buyer's agent that we use, and we're very impressed by the way you guys do stuff. Can you tell us about that path?
I was a radiographer, as you said. One of the constraints I had was actually, working within the constraints of my employer, and then finding time to actually go out and research and actually do what I really enjoyed, which was actually finding the properties and actually seeing my wealth develop. And like most successful investors I meet out there, everyone wants to do, in inverted commas, property full time. I actually made it a mission to do it as a full-time job. And initially, I was helping friends and family do exactly what I did, finding the properties that I found, because there's only so many you can buy. One day, my wife and I decided, it's good to be paid for doing this. And that's how the business was born, and that's how I started doing property as a profession on a full-time basis.
So you essentially become a buyer's agent. That's essentially what you do today as well.
Pretty much, yes.
Just so people understand what a buyer's agent does, can you we talk about it a lot on the show,
Sure.
but can you explain that?
Yeah. So, you've got buyer's agents at different levels. Yeah, there'd be buyer's agents that are aligned to developers, and they're dealing with new stock only, and they could be paid by the developer or the marketing company, or they'd be paid by the client. And then there are people like us where we are more property strategists. And we sit down with you, we work out, help you work out your goals and map out a plan. And then we actually go out in the open world and we source those properties to actually help unfold that plan and that vision, so that you get to your retirement income over a period of time. And we actually get paid by the client and not by the agent or the developer or anyone.
So the person that you're buying the property for pays you for the service you provide to identify, negotiate, and sort of just set that up all up for you.
That is correct. Yes.
Okay. And as a buyer's agent, my experience with buyer's agents has been a good one. I choose to use a buyer's agent for a whole bunch of different reasons. The major one is that I do not have the time to go out and do what needs to be done properly in order to be a good investor. I'm also very conscious that there are other people that can do it so much more effectively than me, and I choose to outsource that, and I'm happy to pay for that service, because when I look at my portfolio and what I've been able to achieve with the amount of time I've really put into it, it's pretty good. So, I always think it's if you can get your head around the fact that, yes, it costs you money to actually get someone to do this for you, the upsides can be considerable, and that's what I always look at, the bottom line. Is that something you come across a lot in terms of people sort of understanding what buyer's agents do and how they get you to do that stuff for them?
Absolutely. And sometimes people aren't able to look at the big picture, and one of my probably shortcomings is using analogy. So I like using analogies, and if I look at a simple analogy, if you're going to a destination, so let's say you're traveling from Campbelltown to Bella Vista in New South Wales, you've got a choice of coming down the toll road, or you've got a choice of coming down the non-toll road. The non-toll road from Campbelltown to Bella Vista takes 45 minutes. The toll road takes 27 minutes. To get to the 27 minutes, in other words, to save that time, you're paying $13.80 in toll when you go both ways. So it is a cost, but it comes back to how quickly you want to get to your destination. And that's what it boils down to.
It's a fair analogy, and I imagine you probably see it quite a lot, people that choose to engage you or whether there's any other buyer's agent. And there's some very, very good buyer's agents across Australia, and we get them on the show quite often. But these people that probably come to you, they have probably got a couple of properties under their belt before they go, oh, hang on a second, I need to get on that toll ride now. I need to start moving faster, because they get a taste for what they can achieve in property investment. But then they work out, I can't do that myself. I don't have enough time to do that myself. I don't have the skills to do it myself. And then do they come to you? Is that generally the dynamics?
That is right. Yeah. So we've got a larger footprint in terms of which areas we can research and which areas we've got access to, and which agents are calling us ahead of anyone else because of the volume that we deal with. And that just makes it a lot more faster.
And Viv, when you chat with property investors all the time, do you find, from my observations, there's not many investors actually get past sort of one or two investment properties, and there's some stats and stuff around this, but is this a common thing that you hear and see, that people that get multiple properties are typically using professionals to help them get there?
Yeah, it's interesting that Victor mentioned that he wanted to do property full time, and that a lot of people fantasize about that. But realistically, for most people, that is a pipe dream, because statistics from the ATO show that I think it's about 70% of property investors never get beyond one or two properties, and only about 6% of them get beyond 7. So whilst everyone might be dreaming of doing it full time, something is obviously blocking their way. And the successful ones that we do talk to that have 30 plus properties, whenever you ask them for advice or what other investors should learn from them, it's always about building the team around them, having a buyer's agent, having a mortgage broker, investing in education, because they just recognise that they can't do it themselves. And they often use an analogy of, you wouldn't try and do your own surgery, you wouldn't try and fix your own car. So when you're dealing with millions and millions of dollars, why are you trying to do it yourself?
So this whole idea of paying a fee for service, so if you use a buyer's agent, you pay the buyer's agent. That's hard cold cash, which is tax deductible as part of a...
Depends.
It depends. We won't go into that, but you need a good accountant. An accountant you pay a fee for. A mortgage broker you don't pay a fee for. The broker is typically paid by the lender, a commission for introducing the business. But these successful property investors that you chat to, are they so far beyond the idea of having to pay a fee for service in order to get the best advice to help them accelerate their investment strategy or their wealth goals?
Yeah, look, it's understandable that people balk at parting with additional money when they already might have worked so hard to save up a deposit. And so 10, 20 grand extra on this kind of thing, they might think, oh, that's unnecessary. But again, when you're dealing with millions and millions of dollars, and you're dealing with wealth creation and retirement and funding, the rest of your life, it's these sophisticated investors that recognise you're just going to have to part with a bit more money to do it properly. And they also say they make the money back very quickly, because an experienced buyer's agent can get them that under market value property that's going to grow more quickly, that's going to give them more equity, and that's going to give them more cash flow. So you're parting with money to make money.
So outside of the paying a fee for service, what are the other sort of critical success factors for people, Victor, to go from 1 or 2 properties to 10 or 20 properties or 50 properties? So what else do you need in your DNA to actually achieve that?
The first thing is, of course, to get away from your current environment. If your current environment doesn't support multiple property ownership. So if you're hanging out with people that aren't investing, and you want to be a prolific investor, you need to go to networking functions and so forth, where you can rub shoulders with them. So that's the very first thing, because you need to have the right mindset and put the right right thoughts in your mind. Then you need to come back to bare basics, basic goal setting. Why are you doing that? And you make that why really, really count. Because if the why is clear enough, then the how will happen by itself. Yeah. So a good example of it is that you need to focus on, okay, what are you trying to achieve in 1 year, 3 years, 5 years, and 10 years in your portfolio, and nut it down to cash flow. you know that in the initial stages, what will happen is that you will have an element of negative cash flow regardless of what type of property you buy, due to vacancy, due to maintenance and so forth. So you need to look at how much of the negative cash flow you can sustain, and whether it'll impact on lifestyle or not. Because that's what slows people down, is that if investing starts impacting on lifestyle, then obviously one partner would say, no, let's slow down. It's not pleasurable. So we try and shy away from pain. So the property investment is causing pain, so we stop. Then we need to then work out what type of property that we're buying to match our own skill set. So if you're a good renovator, you'd buy properties that you can renovate. If you're time poor, you'd buy properties that you'd get other people to renovate. So you tap into some expertise from your team around you, or you're just buying properties that don't need renovation. So if you map out those simple things, you'll find that it starts unfolding, and you have to look at it on a weekly basis to say, where am I heading with this?
It requires a lot of work to keep at it. I look at myself, and we've got a reasonable property portfolio. I don't spend enough time on it, and as a result, I've sort of I haven't deliberately hit the brakes in our buying, but because I'm so busy doing other stuff, all the things that are required in order for us to continue to invest in property and grab it. Like, we don't have any serviceability issues. We don't have any equity issues. We can pull money out as quickly as possible. For me, the issue is finding the time to actually get all that stuff together, to give it to the people so they can sort out
Paperwork.
the finance. For me, paperwork, administration, and so you talk about weekly. So if I'm a property investor trying to go from 1 or 2 properties to 20, 30, 40, 50, what do you need to be able to manage your affairs? You can't just keep it all up in your head.
No.
How do you do it?
In my portfolio, I use technology. So I use Google spreadsheets to track each and every property, and I get my statements fortnightly, and I whack them into a spreadsheet, so that at any point in time, I know exactly where my cash flow is sitting. I know which property is vacant, which one is coming up to be vacant, which one will need work, and in which month. So that each week I'm planning to say, okay, this week I need to actually organize some quotes for, say, a hot water system, or a new kitchen, as an example. Once I've done that, and I also try and make financing really easy for my broker, so I just flick him across the Google spreadsheet, and I use Dropbox to put all of my statements and anything that I'm going to need for finance, and I just share that link. So rather than me trying to find all the information, I let the broker find it in.
So make him work for his
yeah.
commission.
But I make it as easy for him as possible, and then of course, on a regular basis, I have a chat with my accountant, so that I am presenting my financials in the best way possible, taking lending into account. And sometimes that actually means paying tax. I know that's a bad 3-letter word, but if you make yourself attractive to the bank, then they will lend you money, and therefore you can further your portfolio.
You spoke before about getting away from your environment, which might be inhibiting you from realising your potential in terms of investment. So if you hang around with a whole bunch of naysayers and say, oh, there's a property bubble, property's overpriced by 40%, you're going to become broke and poor and all this sort of stuff. And finding people who are dynamic, passionate about property and connecting with them. I know you guys do a thing on Tuesday where you just pull together investors and they just rub shoulders and they get excited, right? So some of those people often turn into clients, but a lot of those guys are just property junkies who just love talking about property. Right. Are these the guys who are pushing forward and getting multiple properties, or do you just meet some people sometimes and go, just stop now, give up, and it's never going to happen? It's there's too many roadblocks in front of you, or are most roadblocks able to sort of you go around a roadblock, don't you?
Absolutely.
Right?
Yeah. So majority of them are easily overcome. There are some cases where you need to wipe the slate clean and start all over again. And one of the things that I have in my experience is that I'm not afraid to wipe slates clean and start again. Because
so what do you remember though? Can you give me some examples?
As an example, let's say in the beginning years of my portfolio, I brought brand new shiny properties as part of my portfolio as well. And I woke up one day to massive negative cash flow because I was focusing more on tax deductions and focusing on how clean and tidy the properties were and so forth. Because I'm not a handy person. I can't I don't know a hammer from a nail. Yet I've done well over in my 19-year career as a property investor. I've done well over 500 renovations in that sense. Yeah, so expertise can be bought, as they say. So we hire a handyman. With these roadblocks, if in my case, I had a lot of negative cash flow properties, so I actually sold them down to then replace them with lesser negative cash flow properties that had better equity in better areas. So don't be afraid to admit to a mistake, and don't be afraid to change tack with the changing market.
And do you think, Viv, the investors you chat to, do people try and hide their mistakes and try not to talk about them?
Yeah, I was just about to mention to Victor actually a couple of investors that I was talking to the other day. They'd suddenly realised that they were cross-collateralised in all the worst ways, and their finances were a mess, and they just couldn't take the next step because their portfolio was such a mess, and they'd been given all of this advice that they needed to wipe the slate clean, and they just were still trying to find a way around it.
Just head in the sand.
And they just were not willing to admit that they really, really needed to start again. So they'd called me hoping that I would give them different advice. And I'm obviously not in a position to give advice, but if everyone's telling you to wipe the slate clean, maybe you need to. But they just didn't want to admit that they'd bought 5 properties and that maybe they'd have to sell and start again. So do you find that a bit, Victor, that people just don't want to sell and don't want to start again?
Absolutely. And most of it is structured around, I'm going to pay tax when I sell. And in that scenario where you've got 5 properties, they are in a position to sell now because we're in a relatively good market. But what if they held on to it and the market tanked and the position worsened? They're in a worse off position. So sometimes you have to bite the bullet and do what's necessary, so long as you then continue with the journey and replace them with better properties.
Well, one of the biggest roadblocks I've seen, or one of the biggest issues that investors face in terms of going from 2 properties to many properties, is that they buy the wrong property at the first investment property is the wrong one, or the second property is the wrong one. And by wrong, I mean that they've bought something which is sometimes an off-the-plan apartment or something that they've built, from scratch, and they end up to their necks in debt on a property which isn't worth the amount of debt that they have against its actual value. So they're fundamentally or essentially stuck for sometimes 10 years before the property grows to a point where it's worth more than the debt they're holding on it, and they've got equity that they can extract to go to the next time around. And if you're paying off a property that's not worth as much as what the loan is, the bank's got problems with it. But typically in those scenarios also is that you're probably not getting enough cash in terms of the rent that it's generating, so you can still save money to actually use again to buy a deposit. And is that one of the typical things you see with the people that you come across, or whether they're clients or just?
Yeah, absolutely. Absolutely, I do. And again, it comes back to the head in the sand scenario, because a lot of times when people are faced with this sort of scenario, they don't know where to turn. They don't know who to turn to. And I think what you need to do is lean on someone who's already gone through that. Lean on someone that's actually actively investing right now, because they will have a pulse, a finger on the pulse in terms of the market. They'll also know what to do, and they may have connections which may help you out. Now, another way, of course, is if you can't sell the property and it's going to be massive losses, is to actually go out and buy what I call a pigeon pair property. So let's say you've got a heavily negative cash flow property. The fundamentals of the property is okay, but the cash flow is all shot to pieces. You can pigeon pair that with another property that might not have such strong growth capacity, but has got phenomenal cash flow, so that you're lessening the impact of negative cash flow in your portfolio.
So it's about diversification, the type of property and its cycle, rather than diversification in areas, or buying a unit in Sydney and a house in Melbourne. So it's about matching the properties together. So hopefully you're going to end up with a neutral-ish position when you look at them side by side.
Correct. Yeah. That way you're sort of immune to what the interest rates are doing, or what more specifically what the equity is doing in the property. Because equity, in my opinion, should happen in the background. You should be focusing on the cash flow. Having said that, I don't believe you should be buying in the mining towns to show up your cash flow, because that is very, very dependent on, in Australia, what China's doing, as an example, determines what your investment's doing here in Australia.
Yeah, it's it's a dangerous game to play, and a lot of people are hurting as a result of it. I imagine there's a lot of people who are sitting there right now with holding on the properties which are worth a lot less than what they paid for them in some mining towns.
Absolutely.
And those people are going down hard. Mate, let's have a quick chat about the market. We're based in Sydney. We talk about the Sydney market, but obviously, there's a lot of markets in Australia. They've all got their own dynamics. There's markets within markets. I think in Sydney in particular that we've ridden a wave of price growth. Some areas more effectively than others over the last sort of 4 or 5 years, and there's a lot of investors who are very happy about it, myself included. I think we invested in the right areas at the right time. We had some good advice around it, which was good. And we've diversified now, and we're investing in other areas outside of the Sydney market, Brisbane, for example, and down in Melbourne. What's your feel at the moment, Victor, about the market? Are you concerned about fears of overvalued, overpriced property bubbles, this sort of stuff? Do you have concerns about the impact that APRA lending requirements have had on slowing down price growth? What's your sort of take?
My experience in the market shows that there's been a definite slowdown in terms of the hype that was in the market with the APRA changes. Certainly the areas that have got good inherent value, they've come back to where they should have been. The agents that I'm talking to at the moment, where they used to have 40, 50 people in an open home, they're lucky to get 10 because it's become harder to borrow. So people aren't just throwing money at the property. And it's a really simple thing. If you look on the internet, you are seeing less of the ads where it says offers above a price. Now we've got either a price range or a firm price. So that shows that the market's sort of stabilized. In some areas there's a slight decline, and I'm monitoring them really, really closely to see when the trend emerges where it's actually starting to flatten out or going into an upward trend, because I don't want to buy in a downward trend market. But most areas have still retained, and these are areas with good fundamental, with infrastructure, change in demographics and so forth. Most have held their value.
Do you think many investors have got the fat in their portfolio, the fat in their serviceability, the fat in their cash flow to be able to capitalise on rivers of cheap properties coming up and be able to take that opportunity and run with it? Do you think there's many out there that can do it?
Look, I'm a believer of keeping your equity liquid so that you can actually capitalize on this opportunity as it arrives. So when you're looking at people that have got their LVR sitting at 90%, they'd be mad to try it. Because you're in declining values and so forth. But if you've got a good LVR across your portfolio right now, whether you've actually manufactured that LVR by doing some smart renovations, or whether you've subdivided or just held for a period of time, you are ideally posed to actually capitalize on this opportunity if it materializes.
Okay, interesting stuff. All right, Victor, really good, mate. We'll get you back in. We could chat about this forever. Really enjoy your insights, and thanks for all your contributions to the publication as well. Victor does a regular blog on Smart Property Investment. That's smartpropertyinvestment.com.au. Go and check it out. He typically writes some pretty good stuff. Not too topical, but the good thing about Victor, he's really happy to share his not only his experience as an investor, but also as a professional in helping Aussies get out there and buy more properties through using his buyer's agent services. So thanks, Victor. It's good. Viv, always a pleasure.
Thanks, Phil.
You can follow us on Facebook, Twitter. Go to smartpropertyinvestment.com.au. If you'd like to know what I'm up to in the world of property and the conversations I'm having with people, you can follow me on Twitter at Philip Tarrant. That's at Philip Tarrant. That's 2 L's. If you've got any questions for us, or you want to hear anything in particular on the show, you have any feedback, positive or negative, as long as it's constructive, get in contact with us. You can email us at editor@smartpropertyinvestment.com.au. We'll be back again next week, so make sure you tune in and subscribe to the podcast. Thanks. Bye.